The Johnson Omega method animated in this clip combines the Omega method introduced by Con Keating and William Shadwick in 2002 and the Johnson distributions published by Normal Lloyd Johnson in 1949 in Biometrica. Besides LTCM crisis in 1998 investigated by the author in 2005, the Lehman collapse in 2008, studied here, was among the worst 2 months in hedge fund industry since January 1990. The clip transparently shows how Johnson Omega generates a superior portfolio out of sample prior to Lehman collapse, as of August 31, 2008. Please note that a backtest over entire business cycle is available upon request.
Johnson Omega optimization.
The initial, equally weighted portfolio remains visible as shaded, while portfolio subject to optimization is represented by filled bars. It is crucial that Moment estimates 1A capturing only economically meaningful and significant economic stylized facts and nothing more, that is excludes implicit and explicit noise and insignificant information. Together with portfolio weights 1B. The portfolio moments too are uniquely determined. Those in turn uniquely determine the Johnson distribution 3, that is the dashed line. The cumulative density provides the minimum expected returns at each probability level. E.g., there is a 5% chance that returns of equally weighted portfolio in subsequent month September will fall below -4.1%. A hurdle which equals the mean is introduced. The hurdle separates the blue area from the red area. The blue area measures the upside potential, and is calculated as Johnson call. The red area measures the downside risk, and is calculated as Johnson put. The put price can be interpreted as the price of an insurance against returns below the mean. The call over put ratio is called Johnson Omega, which is initially equal to 1 by definition of the mean. Please observe weights, moments, options, Omega, as well as minimum expected returns, during the optimization, which will start now.
Johnson Omega optimization result.
The optimization result is as follows. Mean increased. Volatility is reduced. Thus, the portfolio improved already in the main variance, Markowitz, sharp and traditional sense. Moreover, the distribution is bended from negative skewness towards positive. Further, excess kurtosis is almost completely eliminated. As a result, the dangerous fat tail vanished, before Lehman collapse. Thus, the Johnson Omega shifts and bends portfolio distribution, which becomes better in the traditional mean variance sense and furthermore has superior tail properties. Downside risk, that is Johnson put, is massively reduced, while upside potential, that is Johnson call, is increased substantially, implying an increased Johnson Omega. In particular, tail risk becomes much lower, body only slightly weaker upside tail. E.g., after Johnson Omega optimization there is a likelihood of 5% that returns of the Johnson Omega optimized portfolio fall below -1.6%, which is a substantial improvement. Density is almost first-order stochastic dominating, that is preferable by each rational investor irrespective whether risk-lover, risk-averse, and as utility function.
Optimization minimum variance.
The minimum variance portfolio is added in orange. Expected mean is poor, due to ignorance of downtrend. Its volatility is slightly lower. but a substantial fat downside tail due to negative skewness and high excess kurtosis. Higher downside risk despite of lower volatility, which in turn destroys upside potential. Ignorance of the trend, which is one of the most stable and best understood stylized fact and Financial Times series, and ignorance of skewness and kurtosis leads to inferior portfolio.
Optimization maximum return.
The maximum return portfolio, added in yellow and incidentally equal to the optimal Sharpe, has highest expected return. It has also highest risk due to a high volatility, which is even amplified by a fat tail, due to slight negative skewness, combined with significant and substantial excess kurtosis. Downside risk increased stronger than upside potential, leading to inferior Johnson Omega. Highly risky, in particular fat tail risk to downside.
Optimization summary.
Aggregates ex-ante Lehman collapse expected performance. The table summarizes the moments, showing the superiority of the Johnson Omega optimized portfolio in contrast to its peers. The moments uniquely determine the Johnson distributions. More illuminating, in particular what happens in tails, is shown by the logarithmic chart. Johnson Omega achieves an improvement with respect to capital protection by magnitudes, as can be seen in the quick decline of the blue curve for negative returns. Overall, the Johnson Omega portfolio has a clearly better expected upside over downside relationship in tails. Economic reasoning is that the superior Johnson Omega achieved through fully exploiting long macro and short emerging market potential, by squeezing juice out of data completely and the capacity to process information rigorously. All other portfolios have dangerous fat tails, in all cases with at least a tendency towards the downside.